So before we get started, I do have just a couple housekeeping items. Hopefully for those on the phone and then in the room, we sent out, in addition to the invitation for today, a second media advisory that also included tentative dates for 2019 director's cuts. Those are posted on their website too in the information center. So, and those will be posted there throughout 2019. So if there's any changes or edits to those dates, that's where they'll be posted, or we'll just send out another media advisory so you know when those dates will be. And then for those who are dialing in, please just make sure that you keep your video cameras and your microphones muted and no screen sharing. That just allows us to manage the system a little easier, so folks can see what we're chatting about. Otherwise, I will let Lynn take it away with the director's cut for November.
Thank you, Katie, and thank you everyone who came to see us on a very snowy day, and those who logged in. So we're talking about September production. There's always that 2-month lag in terms of aggregating the production and then getting it reported, but we'll talk about it. Basically, the oil and gas industry in North Dakota virtually broke every record in September. So we had record oil production, up over 5%, up more than 66,000, almost 67,000 barrels of oil a day. Record natural gas production, up 89 million cubic feet a day, up about 3.6%. I think it's interesting that this is the first time in, I went back 3 years, and it goes back further than that, that oil has actually increased more rapidly than gas. So a little bit about what Justin and I have been talking about is taking place as activity moves out of that core area where the gas oil ratios are really high. We're starting to see a little bit of moderation in terms of gas oil ratios, and so we're seeing oil and gas synchronize a little bit more. Broke the record in terms of the number of producing wells, went up more than 160 wells to almost 15,300. We're seeing the effect though of winter setting in and oil prices. Rig count has dropped 5 since October, and I think we'll continue to see it decrease over the next 2 or 3 months as this low price scenario sort of sets in. OPEC is going to meet on the 6th of December to decide what to do about oil prices. Oil prices are well outside the range that OPEC wants them to be in. They want Brent crude or world crude price between $70 and $80 per barrel. And we're seeing North Dakota Sweet selling at sub $40. Bakken crude, of course, is selling at probably $5 to $6 a barrel above that, but still well below the numbers that it takes to grow the rig count or to add a lot of wells to the inventory. So it remains to be seen what this oil price does, but it's super soft right now. And OPEC has been warning that in 2019, there was a danger of oversupply. It looks like some of the big oil consuming economies are slowing. China, India, the US, some slowing in economic growth. And so over the long haul, that was going to result in some temporary 2019 oversupply. But the number of exemptions have been granted to the Iranian sanctions have really oversupplied the market. And so US storage jumped by enormous amounts, over 10 million barrels this last week. And so we're seeing, again, back to a very oversupplied market, which OPEC doesn't like making U-turns. And so early in the year, they had cut production to raise the oil price. Then the announcement of the Iranian sanctions came along, and they said, you know, we're going to have to produce more to compensate for that because we don't want oil prices to go too high. So about the time that OPEC and Russia agreed to production increases, all of these exemptions went into play, and the oil price has dropped dramatically, about $15 a barrel. So they're making another U-turn. Stay tuned, December 6th. We'll find out what it is they're going to do. U.S. producers have not slowed. U.S. production is anticipated to reach 12 million barrels a day next year. And so that's going to have to be dealt with in the world markets. All of that means that where we are, with the weather conditions we have, the lack of workforce, the transportation issues that we have, this is going to slow activity. It's going to slow growth for the next few months. So good news on the inactive well count. It was down significantly. 87 wells came off the inactive list back onto the active list. So we haven't been below 1,400 inactive wells for quite some time. I didn't look up the date, but it's been a long time since we've been down there. So that's great news to get those wells back in production. The production increase fairly evenly distributed. So a significant production increase on Fort Berthold is up 10,000 barrels a day. Drilling rigs on Fort Berthold up 1. Let's turn a little bit to natural gas and gas capture. Industry captured a record amount of natural gas. I've started reporting the amount of gas captured, and it is a new all-time high. They managed to hold that capture percentage. It's below the 85% goal, but they managed to hold it right around that 82%. So flaring was up a bit, but not a huge amount. We're expecting October to be worse, and so we'll see how that is. I think when you look at the numbers, you can really see where the issue is. Fort Berthold capture only 71%, as opposed to non-Fort Berthold at 85%. So we're going into a very difficult situation going into winter, below the gas capture goals and significantly below on Fort Berthold. That raises something else I wanted to talk about. The Bureau of Land Management came to town day before yesterday. They were actually here 2 days, and they were letting the tribe know, the oil industry know, and us as well, that the new revised venting and flaring rule, or waste prevention rule, calls for them to defer to state or tribal regulations. What does that mean? Well, what it means is that they are not going to have flaring regulations. They are going to negotiate an agreement with the state for us to tell them when a well is in non-compliance, and that's when they'll decide to require royalties to be paid on the well. And their intention and the discussions with the 3 affiliated tribes is that the 3 affiliated tribes is going to put together a resolution, and they're going to take over flaring regulation on trust lands. So everything is going to change about how flaring and gas capture is regulated in the state of North Dakota. I think it's good from the Bureau of Land Management standpoint and from the federal government standpoint to step out of that and let the local authorities regulate it. But it's going to be a challenge for the 3 parties of us, the state, the tribe, and the Bureau of Land Management, to come together on agreements and resolutions that properly regulate flaring. So again, stay tuned. Next year is going to be very interesting as this rolls forward. That rule actually takes effect a week from Tuesday, November 27th. No one expects the agreements are going to be in place by that time. There's just no way, with Thanksgiving coming and the fact that they just came to see us this week. However, the essential effect is it will affect December production going forward, and that production won't be reported to us until February 5th. So it'll be all hands on deck to get these resolutions and agreements in place by the 5th of February. So January, with the legislature in town and with that going on, it's going to be a really busy month. So we have a lot of work to do to work out how we're going to regulate flaring in North Dakota during the month of January and have that in place by the 5th of February. The other, one other item that I wanted to draw your attention to, and it's, well, there's 2 actually. under the federal part of my director's cut, there's a new entry, the U.S. Forest Service. So the U.S. Forest Service published a proposal to revise, it was published on the 2nd of November, to revise the resource management plan for the Dakota Prairie grasslands. And there's a significant shift in terms of how land in the Dakota Prairie grasslands is going to be treated. There is almost 33,000 acres that's going to move from, or that under their recommended alternative, would move from timing and controlled surface use to no surface occupancy. So that's a lot of land. And so the Industrial Commission will be looking at making comments on that and what the impacts of that might be to oil and gas development on Dakota Prairie grasslands. Those comments are due by the 17th of December. So again, busy time during the holiday season here. That came out the 2nd of November, so there's a lot going on. The last thing I wanted to talk about was we redid the break-evens. Now again, keep in mind these prices that we calculate don't represent a price where an oil company would achieve an acceptable profit or return on investment. It's a pure break-even number. But what they do show is that virtually anywhere in North Dakota, oil companies can profitably drill for oil and gas at today's WTI price. So at $56 a barrel, current WTI, there are just a few counties in North Dakota, Golden Valley in particular, we don't have any data. So I can't really say how economic it is there, but every other county except Bowman and Slope, it's economic to drill for oil and gas in North Dakota, even at today's prices. Bowman and Slope is unique in that that is the big Cedar Hills water flood, and that is scheduled for enhanced oil recovery next year. So a major pipeline is going to come to Bowman from Bell Creek, Montana. It's going to come to Baker and then across the line into Bowman next year. And it will start to deliver carbon dioxide from Wyoming to the Cedar Hills field by the end of the year. So there will be drilling activity and a lot of well workover activity, a lot of oil and gas activity in Bowman and Slope County. At one point in time, when North Dakota produced about 100,000 barrels of oil a day, Bowman was more than 50% of that. It has since declined to be only about between 20 and 30,000 barrels of oil a day. Carbon dioxide should take it back up to those peak rates. And so that's going to be really good news for Bowman and Slope County. That's all the prepared remarks I had, but I'll be happy to take questions.
One really quick one, since you're just off of break-even prices, someone is looking to just clarify what you mean by pure break-even number.
Yeah, so what I mean is that based on the well costs that are presented to us in our oil and gas hearings and the production rates over the last year in that county, at this oil price or at that oil price, a well would pay the drilling costs back. Pure break even means you recover the drilling and completion costs. So it incorporates what they tell us the operating costs are going to be, what they tell us the drilling costs are going to be, what the historical production rate for new wells has been over the last 12 months in that county, and then the West Texas price. So you just get your money back at a pure break even. Most oil companies want a 20+% rate of return to incorporate the risk and everything. So these don't incorporate any rate of return or any risk value.
Any questions in the room?
Can you elaborate a little bit on the BLM agreement? Is that going to focus on royalties that are paid, or?
That will be their focus.
Okay.
So what they're doing through the rule is saying the state of North Dakota, outside of trust lands, the tribe on trust lands will regulate and control how much natural gas is allowed to be flared. or how much oil production is allowed to produce and flare. But both the tribe and the state will be required to report to the BLM whether a well is flaring in compliance with the rules or not. And if it's not in compliance, then the gas will be ruled as, trying to remember the exact term that they use. But anyway, the decision will be that royalties are due on that gas.
Okay.
Yeah. So I think they call it unavoidable flaring
Okay.
versus avoidable. And so if the well is not in compliance with either the state or the tribe rules, then the gas will be ruled as the flaring was avoidable and royalties will have to be paid.
Okay.
So that's the BLM's concern. Now, that impacts a huge number of wells in North Dakota. Every well in a spacing unit that has any federal minerals has a federal interest. So that is roughly 1/3 of all the wells in North Dakota. So even if there is just 1 acre of federal minerals in that spacing unit, all of the wells in that spacing unit then are tagged with a federal mineral interest. And so the royalties would be due on all those wells in that spacing unit if it's not complying with the gas capture goal. So it's going to be a very significant change, and we have to really think about how we want to implement that so that we don't trigger some kind of strange unintended consequences. One of them we thought about is that it would be possible to either discriminate in favor of or against federal minerals, but by incorrectly applying the rule. So, I mean, you could incentivize oil companies to gather federal gas at the expense of private mineral owners, or vice versa. So we got to really carefully think about how we're going to handle that with the BLM. But yeah, as far as the BLM is concerned, it's going to be, our royalty is going to be required on that gas when it's flared.
Looking at the drop in sweet crude prices in North Dakota, you had mentioned weather and an oversupply. Is that price expected to drop further in the coming months?
Great question. The question in the room was this very significant drop in crude oil prices in North Dakota and the winter weather coming. Do we expect a further drop in the coming months? And I think our answer would be no. We think we've seen the bottom. The markets reacted very aggressively to the exemptions that were granted to the Iranian sanctions. And Saudi Arabia has already announced that it's cutting production 500,000 barrels a day in December. And they have this meeting the 6th of December, and they're in negotiations right now with Russia and the other OPEC countries to talk about what they're going to do with crude oil production to boost the prices back up. So no, we think we've seen the bottom.
When can you expect to see that price begin to level out again?
We actually think by sometime in the first quarter of next year, we should see those prices, back into the territory where drilling grows in North Dakota. But
when things thaw out a little.
Yeah, but in North Dakota, winter doesn't end, and the road restrictions don't go off until the second quarter. So we think we're going to see price support and solid prices the first quarter of next year, but we won't really see activity pick up probably until the second quarter.
A few additional questions here on the venting and flaring rules with BLM. Specifically, looking for if some of the methane regulations will cause oil and gas production to drop anyway, or how it could impact production. Secondly is if we anticipate or would know of any possible lawsuits from oil companies reacting to some of those royalty requirements on flaring.
So lots of pieces to that question. I'll start with the lawsuits. I'm not aware of any lawsuits at this point reacting to the requirement to pay royalties. I am aware that the states of California and New Mexico have challenged the revised rule, and they've taken it to court in federal court in California. So it's going to be litigated. But because it takes effect a week from Tuesday, we have to act as though it's going into effect and put our plans in place. As far as the methane restrictions, that part of the rule was revised as well. Rather than defer to state rules, though, in that case, what the BLM said is EPA regulates that. We're going to defer to the EPA Quad O regulations with regards to methane leaks and methane emissions and all of that. Having said all that, the air quality standards are about at the same point as our gas capture regulations, in that industry is essentially flaring as much gas as is going to be allowed. I mean, the numbers that you're seeing right now are pretty much at the maximum of North Dakota's gas capture regulations, but also the air emissions standards. So I don't see it causing companies to reduce production, but it is going to inhibit growth. We're not going to see month after month 60,000 barrel a day production growth. That's not possible at these prices, and it's certainly not possible with the change in the flaring regulations.
Can you elaborate on, you said that you expect flaring to be high in October. Was there any outages, or why do you expect it to be higher?
Yes, thank you. The question was, why do I expect flaring to be high in October? A couple of reasons. The primary one is that One Oak's state line gas plant was down for some significant maintenance. And so they issued a lot of what they call rolling capacity curtailment letters. So that, if you recall, I think there was a fire there last year. And so there's some significant maintenance going on. Also, the Wild Basin plant had its ribbon cutting in October, but it has yet to reach plant capacity. With the weather situation and everything going on, they're struggling to get that plant up and running at capacity. So I think the producing industry did not anticipate those two things happening, and so they completed wells and put wells on, and the gas had no place to go. So I think October is not going to look very good in terms of flaring, just because of that. Now, so the flaring numbers will probably be pretty high. The capture numbers may be low, but again, those types of things might fall into a force majeure or some other part of the gas capture policy. So they're not likely to result in production restrictions, but they are certainly going to impact the flaring numbers.
You talked, Lynn, about activity moving. Can you discuss more, maybe outside the core, where it's moving to or where it's moving from? Okay.
I know more about moving to than from. Actually, I think we got all the rigs that were working in the core area are still working in the core area. It's just that the new rigs that have been added outside. The two primary areas there are up into Divide County and then up into northern Mountrail and Burke County. Those two areas had gone for several years without any drilling activity. And now with the advent of the 3 mile long laterals and the new completion techniques, they're much, much more economic. And so we're seeing southern Burke County and northern Mountrail County turn on, as well as parts of Divide County.
Any other questions in the room?
Can you comment on what you're going to be recommending on Tuesday for the gas capture policy, for the state policy?
I think it's too early to do that. Thank you. The question was, can I comment on what's going to be recommended Tuesday to the commission? I just met with some commissioner staffers yesterday to go over the first draft. And so, yeah, it's too early. Thanks.
This is the battery pack.
Sorry.
Wow.
Oh, thank you. Sorry, I didn't know that.
That's my little one.
This is a little one. Okay.
Looks like it goes through power drill.
Mhm.
Yeah, it does. Got a heated jacket that it fits into as well. All right, are you ready to go on your end, Katie? Perfect. Okay, well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. Got a few things we're going to focus on today, but we'll get started with just the traditional update on everything that's taking place in the neighboring states. One interesting thing that as more data is coming in into the Montana record system, you'll notice that Montana production, the way it gets reported is a little bit differently than North Dakota. They add production as it comes in, and so you typically see months continue to add up as we look backwards. So if you take a look at the trend, for quite some time it looked as if Montana production was decreasing, and now appears to be holding fairly steady. There's now 2 drilling rigs as of today active on the Montana side of the border, which is up from no activity not too long ago. South Dakota has been holding fairly steady. And one key number that I want to focus in on this table, it doesn't exist there, but if we were to assume that Montana and South Dakota were fairly steady as far as their production into September, that would put North Dakota production just over 1.41 million, or I'm sorry, the Williston Basin production on the U.S. side at 1.41 million barrels per day. That's a critical number when we start talking about pipeline capacity here in a moment, because we do share the same network with these other states. And so this is why every month I bring this table up, and it may not always seem important, but it is once we start getting to some of these critical data points. On the production side, you'll notice up in green, that is the month-over-month change in oil production. You'll see that we have had several spikes and high monthly changes. However, as Lynn alluded to, I'm in the same boat. I don't expect this type of trend to continue at least into October at this type of volume. I do continue to see growth in the near term, but typically when these large months occur, they're followed up by much smaller month-over-month gains immediately following it. So we'll keep an eye on that going forward. On the transportation side, again, very little shift taking place. Again, as things have been marching forward on a production standpoint, transportation's been keeping up. Just some very slight changes. Slide 5 is the trend line. You'll see a little bit more crude oil being moved by rail car, and we'll talk about the market dynamics here in just a moment of what may be driving that. The key thing is always that price indicator between the Brent oil markets and the WTI oil markets. When we look at the Brent WTI spread over the last number of weeks, it has been hovering right around that $10 spread, which is certainly above that $5 to $6 threshold that I typically use as a benchmark for when it becomes economically attractive for a shipper to move crude out of North Dakota by rail. There's some other pricing dynamics that Lynn started to hint on as well. The pricing within North Dakota that is being impacted by what's been taking place in Clearbrook, Minnesota. Clearbrook, Minnesota, if you're not familiar with that, the importance of that point, it is where the Canadian mainline system of Enbridge comes into the U.S. It's also where the Enbridge system leaving North Dakota intersects at that hub at Clearbrook. And during the last month and a half or so, I don't believe I have a chart here, but I do have some background information. Pad 2, refineries that are active in Pad 2 went into some significant turnaround late this fall. And at some points in time, almost 1 million barrels per day were taken offline. And so crude oil began to start backing up into the Midwest, into that Clearbrook market, which again is that first major market hub in the U.S. Today, as of the EIA data I was able to get this morning, still about 500,000 barrels per day below normal as far as refinery throughputs in Pad 2. And so that Clearbrook market has just been severely congested. The pricing at Clearbrook has suffered. It's been impacting Canadian prices as well as North Dakota barrels that get marketed through that hub. and we're starting to see that start to trickle back into North Dakota. And so as of this morning, Clearbrook was right around $15 below WTI. So a pretty significant discount that we haven't seen in Clearbrook for quite some time. In the far past, it did have some pretty severe ups and downs, but just over the last month or two, that marketplace has really been struggling to keep up with the WTI pricing. The latest pricing that we have from North Dakota is obviously from September. So we don't know exactly how, on a hard number basis, what this is meaning for North Dakota and what that discount will be, but it's going to be higher than we have been seeing through the summer and fall months. September was just over $5 North Dakota pricing below WTI, which again is kind of in that normal range. But once we start looking at October, November, I'm fully expecting that discount to increase significantly. So with that, getting into the rail side on slide 7. So along with that Brent WTI spread, there's that North Dakota Brent spread, which for the months of October and November so far are quite large. And so I would suspect that even though we've been seeing some trends of additional barrels going by rail car right around 300,000 barrels per day in September, that as the October and November numbers start to roll in, that we should see that continue to uptick as marketers are looking for, again, that best priced market and options for crude oil to leave the region. Where those barrels are headed, very consistent. Most of the barrels continue to head to the PAD 5 Pacific Northwest, and then the remainder of those barrels heading over to the East Coast. At least for the month of August, all of the Gulf Coast deliveries had ceased in the EIA database. And then just an August update on pricing. Strongest pricing remained on that PAD 5 West Coast, followed up by the East Coast, and then again, Gulf Coast being the third highest overall market price. Again, with Dakota Access having direct connection to the Gulf, we are seeing those barrels by rail moving again to the east and west parts of the U.S. And pricing as of today, continuing that strong over $10 spread between Brent and WTI. Gulf Coast just over $8 for that LLS benchmark. Slide 11, this is something that, again, I bring it up every month. It's been something that a lot of folks, including myself, we scratch our heads each month trying to figure out what's taking place. I think over the last month, I've gotten more calls on this chart and discussions with folks in the last month than I have in the first 10 years of looking at this information.